Hi guys. Diego, are you sticking around? I think you'll be interested in this panel too. So Diego had a great presentation, and I pretty much do what he does, which is Markowitz. So I'm going to show a few slides. I'm going to introduce myself and talk for a few minutes about Alpha, and then we'll have the panelists go into what they do. So for those of you who don't know me, I manage two strategies. I manage a mortgage-backed security strategy and a systematic strategy, creating active portfolios, actively matched portfolios in fixed income and equities using ETFs. As Diego said, you need liquidity to be active. And so, but I'm going to, I think, complement his presentation with a couple of slides. See if I can figure out how to do this. Okay. Okay, so one other thing is my company is called MBS Mantra for the mortgage stuff and Alpha Research and Management for the systematic stuff. I spend all my time trying to figure out how to generate alpha and monetize risk. So what people don't know about the markets is they don't really think from a risk perspective. In fixed income, we've never had this level of risk before. This chart goes back to 84. So there's not a single portfolio manager around in fixed income that knows how to build a portfolio for this level of risk. So what does that mean? First of all, large firms have no advantage. You should be looking at guys that know how to have figured out how to deal with risk. Risk targeting is far more important than yield targeting. So when you have high levels of risk, this is what happens. So this is the return, the 3-year total return of the AG, which is used to be the old Lehman AG, which is the universe of investment grade portfolios. Now it's owned by Lehman, became Barclays, and Bloomberg bought it from Barclays, so it's now called Bloomberg AG Index. And this is the benchmark for fixed income. So the cumulative return of the AG has been negative for a few years, even though every fixed income manager has been on TV extolling the virtues of yield. We finally have yield, we have income, and their returns have all stunk. So if you, this chart also gives you a very simple way to identify alpha, which is 3-year total returns, by the way. It's the asset test for alpha, in my view. So how have these guys been building portfolios? They're using some, if you follow Warren Buffett, he talks about Graham Dodd. So Graham Dodd is wrote a book in 1932 called Security Analysis. It's all about picking stocks, bottom-up analysis. And the underlying implication or assumption is that markets move in a random manner, the random walk. This was a formulation from 1860, the random walk hypothesis. And so Graham Dodd assumes that you can't do anything, you can just value stocks. And the only way to manage risk is through diversification. So so all of fixed income, more or less, is using Graham Dodd for portfolio construction. This is taught in CFAs, this is taught in MBA programs, and everyone is really just doing dogmatic diversification and portfolio construction by picking bonds and securities. And what this chart has shown is that when risk picks up, portfolio construction and diversification has not delivered. And there's a very simple reason for that if you think about it, right? Yield is, let's say, 6%, right? So that's 0.5% a month. The duration of this stuff is 5 to 10 years. So a little move wipes out your income completely. And the price risk dominates when risk is high. When risk is low, then you can keep clipping coupons and get a little more outperformance. And in terms of alpha generation, it's so easy to manipulate alpha. What these guys all do is they go outside of the benchmark and pick yieldy stuff. They buy preferred stocks and convertible bonds or high yield bonds. And now you're getting a few beeps of extra coupon, and they call that alpha, even though they're going outside of the index. So you can, alpha selection, you have to pick an index, but at the end of the day, the 3-year total return is a good benchmark. So here we've got the same total return of the ad, but I've got PIMCO and BlackRock's active mutual funds, and you can see that they behave differently. When the vol was low, one is better than the other once in a while, but they're doing different things because they are trying to be active, right? However, when vol is picked up, they are just tracking passive completely. In the meantime, every money manager and his mother is issuing an active ETF, an active mutual fund. And these things are all a waste of time because they don't understand risk and volatility. They're just doing security. They will continue doing security selection because that's what they've been trained to do. And they won't generate any alpha in their active strategy. So if your wealth manager is trying to get you into this, avoid. This is the close-up of that chart. So by doing Markowitz instead of Graham Dodd, you can pick up alpha and manage risk. So the top two lines are two of my model portfolios that use Markowitz, and you can see that it outperforms. I don't want to talk about my stuff that much, but really focus on the risk part and the process of understanding risk. Here's another interesting chart. So people are not aware of this either. This is the, Diego hinted at this. This is the beta of equities to fixed income, right? So if you look at the early pre-2000 years, the beta is negative. So it's volatile. It's been slightly negative for the most part. But this is the entire premise behind the 60-40 portfolio, behind the concept of fixed income diversifying equity risk, behind risk parities, Ray Dalio's thing. It's all about this negative beta between equities and fixed income, right? In the past 5 years, equities are +2 beta to fixed income. So equities have become not just fixed income, they've become levered fixed income. So the 60-40 portfolio has failed. Diversification has actually failed in terms of equities versus bonds, right? Because all you have is fixed income risk in the equity market also in a levered manner. So, when you treat an equity portfolio using a fixed income Markowitz framework, the alpha gets really stupid. So in using my fixed income algos for using Markowitz, the alpha in the fixed income stuff is between 5 and 10% annually. The alpha in the equity stuff is almost 25% annually. And it's just by actively trading, actively targeting risk and constructing portfolios and actively constructing portfolios. So what this chart also shows is essentially a correlation and covariance of equities versus fixed income. Now, if you throw in other asset classes, you end up with a covariance matrix, right? And that's the entry point for Markowitz. So by using these few tools, you can now actually construct portfolio optimization of whatever portfolios you're looking at by looking at historical data. So, but this is one way to generate alpha. The other ways are through taking on illiquid assets, taking on just going outside of securities, Bitcoin, gold, and so on, other commodities. And so there's many other ways to construct portfolios. And our panelists are going to discuss some of those. Yes, Steve?
Beta component spread between betas today going forward between stocks and The equities and.
The beta is gonna be what it turns out to be, right? This is a historical number. I'm expecting this to stay pretty stable going forward. I think the reason why this beta is positive is because stock valuations have gone up so much, and a lot of zero return. The return of your principal has gone up so far that equity duration has extended to the point that it now dominates the discounted cash flows of the equities. So equities are now just a bet on recovering your principal with 100 P, right? And so the duration is extended. I think that's why it's gone. So when will it revert? After a crash? So let me introduce our panelists. So we have Dale Wang from Alpha West, Mitchell Dong from Pythagoras, and Tyson Halsey. Let me get rid of my chart. How do I stop sharing?
Income Growth Advisors.
Income Growth Advisors. And so I'm gonna, they all do very different things in terms of how they manage money and their strategy. So I'm gonna let them introduce themselves, and then we'll have a conversation with some Q&A.
Make sure you all turn on your microphones.
So
We're on.
Dale, go.
Hi, everyone. My name is Dale. I'm a partner and CEO at a emerging fund manager called Alpha West. Our primary strategy is something called sector rotation. So we tend to focus on longs in the undervalued sectors and sell out of overvalued sectors. We express the strategy through multi-sector ETFs as well as thematic ETFs. And I think prior to this, I think part of the conversation is looking at uncorrelated asset classes. We're doing something called GP minority staking. So we can talk about that as well.
Mitchell.
Hi, I'm Mitchell Dong. I have a bad back, so I can't sit too long. So if you don't mind, we'll creep around a little bit. So I run a hedge fund that's purely trades Bitcoin.
You're gonna get off camera.
You've gone off camera.
I've gone off this camera.
Yeah,
Okay,
you're
right.
I guess.
Got it.
Yeah.
Okay, so I'll just stand over here then.
Yeah.
So I run a hedge fund for the last 10 years, since 2014, that trades quantitative systematic strategies on Bitcoin. If I had just 10 years ago just bought Bitcoin, I would have made a lot more than trading it in a hedge fund. But that's what Diego said about doing the right thing at the right time and the right amount. I didn't do the right amount. I didn't do the right thing. And I got the wrong strategy. But anyway, having said that, I had fun, right? So I've been trading crypto systematically for 10 years. And we have a variety of different strategies depending on my and your risk return profile. We've got stuff that's like really low risk, like arbitrage, buy it in the US, sell in Japan when there's a price difference. There's stuff that's stat arb, that's 100 tokens long, 100 tokens short, very similar to statistical equity arbitrage, which has a little bit more risk, but has very controlled volatility. We have trend following, which is a little bit is directional and takes on a little bit more return, a little bit more risk. And then we have a fund that beats Bitcoin by having a core holding of Bitcoin and added to it a number of different quantitative strategies. So the question of alpha, where's alpha in Bitcoin? You can just buy Bitcoin and say, well, that's alpha because I'm in the right asset class in the right amount at the right time. Or you can actively manage your Bitcoin or actively manage whatever you're doing in crypto. And there are many, many different traditional styles that can be applied to crypto. And many of them, like arbitrage, have been arbed out in traditional finance, but still available in crypto. Or even trend following has many times been arbed out in traditional commodities, but not yet in crypto. So anyway, that's me.
Tyson. Oh, sorry. Tyson?
Yes, I'm here.
Can you introduce yourself?
I've done everything on Wall Street. I've run a couple of hedge funds. I started on the floor of the New York Futures Exchange. I worked at Merrill, Deutsche Bank, Alex Brown, and I run an RIA. And I have ideas based upon my kind of CFA trading and training. And I think that the portfolio I'll show at the end really addresses many of the issues that you brought up, Samir, and that I think that there is great alpha to be found outside of the traditional 60-40 large cap passive index type strategies, which is where the bulk of the money is. And I think that we're going through a great rotation today where those people who look at past cycles will see where good money can be made, both on the fixed income as well as on the equity side. So I look forward to showing a couple slides to summarize all that.
All right, thank you. So let's start with Dale. So you do sector rotation. Where do you, is it systematic? Do you have quantitative models, or is this,
It's discretionary active
I'm
trading.
sorry,
Discretionary and active.
discretionary active? And are you using liquid products or?
Yeah, we mostly use liquid ETFs, thematic ETFs, as well as sometimes using levered ETFs as well to achieve additional alpha.
So can you share where you think the opportunities are, the value is? What are the risks of these sectors? How are you thinking about constructing portfolios in the current risk environment?
Yeah, so I think just given the strategy, we break down S&P 500 into individual GIG sectors. We look at it both at a fundamental perspective, looking at historical PE, forward-looking PE, and my other partner, who is more of a technical trader, will look at technical analysis to identify, entry points and exit points. Currently in the, I would say, slightly weaker growth environment, stickier inflation, higher inflation environment. Most of our long bias bets are on the defensive sectors. So we're in, consumer staples, we're in utilities, we're in healthcare. I think that though all three of which has been historically trading lower forward PE versus where the historical mean has been. We're big believers in mean reversion. And I think another, sector of interest is actually the energy sector. It's been traded, fairly undervalued at 14 times future PE versus historically 20 plus. Right. So I think those are the sectors that we pay most attention to.
I actually like the energy sector because of the free cash flow it generates. Plus, historically, with the prior administrations, there was a real pushback against investing in energy. So the energy companies have been returning CapEx to the investors. With the current administration, that may change. What are your thoughts on that? Will the free cash flow continue, or will they start actually investing in CapEx again and reducing the free cash flow?
I think there is a temporary reduction in free cash flow, but I think that over the long period of time, if you're looking at medium to longer time frames, what you generally look for is inflation protection, right? Which is why people get into commodities in the first place. I think commodity-linked equities are interesting. So, your energy producers, your mining companies are the ones where you're going to find some growth in the equity itself, as well as you receive a payment of dividends as well. So I think that's what the opportunity is.
Can I ask a question?
Absolutely.
So as an inflation protection, how would you compare energy, gold, and Bitcoin?
I think gold has historically been the standard where people look for inflation hedges, whereas Bitcoin is something new that has come along. And I would say the last 5 years, there's been a lot of attention. The first time I've actually looked at Bitcoin was actually in 2015, which was a misnomer at the time, right? And, slowly looking at, allocating part of my own portfolio into Bitcoin in late 2019 after the initial crash. So I think that, yes, people do see it as a new way of the new digital gold, if you will, whether you think of it as a store of value or an actual inflation to hedge. But I think people need to understand the correlation of Bitcoin and its volatility to other risk assets or high beta assets.
So have you done any quantitative analysis comparing the three?
No, no.
Tyson, this is right up your alley. Discussion about energy. Oh, sorry. Tyson, this is right up your alley, discussing energy and gold. And so you want to jump into the conversation with your thoughts?
Yeah, I think that energy and gold make a lot of sense. Is it okay if I show a couple of slides to expedite? Or...
Absolutely. This is free form.
All right, so let me just do this. So I have to open my PowerPoint. Forgive me. All right. Can everyone see that?
Negative.
Negative. All right. Well,
You have to,
1 second.
You would share.
you have to click on sharing and then select the screen you want to share. There we go.
All right. So I think we're in a new age, and there are new market dynamics and the rules of the last 40 years, which have been driven largely by a major decline in interest rates from 15% to about 0.5%. You know,
Tyson, put it on
really,
a slideshow.
I'm
Slideshow.
sorry. Do you not see that?
We see it. Just put it on a slideshow.
Okay, 1 second.
The top bar, yeah.
There we go. You all see that? Does everyone see that?
Yes. we can see
All
that.
right. So I think that we're in a new age, and right now I think we're also in a major topping process. This thing's going automatically. It's driving me nuts. Sorry. But I think that the primary risk to the market right now is that the U.S. equity market, the S&P 500, is overvalued, and it's overvalued not on traditional valuations alone. I think the critical thing is it's overvalued relative to the yield on the U.S. Treasury. U.S. Treasury is now giving us competition, and from this multiple, the typical next 10 years return on the order of 2 to 3% from forward PE. And I'm sorry, I'm not used to this going automatic on me. But we're in basically a bubble, and we're seeing it particularly in the Magnificent Seven. And I think that what you need to do is you need to be looking abroad to other places, both geographically as well as in asset classes. And here is a nice chart from Crescat Capital. And here's the CAPE ratio. The Magnificent Seven is at 58. The US and India are at 33. And right here, this is where I think that people ought to be looking for, equities and bonds and hybrid investments. So Argentina, Brazil, Hong Kong, South Korea, China. I think that's really where alpha is going to be found. And I was asked by Samir to talk about the peak. I think I studied Schiller a lot. I read his Irrational Exuberance about 6 times, and I think that psychology has a lot to do with what happens in the market. And we go through these irrational periods, and I think that NVIDIA's peak is emblematic of that. I think that invariably the law of large numbers, you're seeing decelerating earnings and competition. And I think the multiples are going to collapse, and because it's the largest market cap company, it's going to drag down all the major indices. And the other way I like to look at this is in terms of cycles. We go through periods where there are major peaks, and following those equity peaks, whether it's 1929 or 1970, 71, or in 2000, in the periods that follow it, then you see inflation. And during that period, gold, oil, and the emerging markets tend to do well. And that's where we are now. And again, I think that you don't want to be in bonds. They were a layup for the last 40 years, but now we really don't know where inflation will be. And I don't think that they're worthwhile on a duration risk basis. You want to be in the emerging markets. Here you see in that period following the bubble in 2000, emerging markets significantly outperformed the US. I think we'll see that again in the years ahead. You saw that in China, where that emerging market did well. It's no longer an emerging market, so places like Argentina make more sense. And I'm almost done. I think that you want to be in other sectors, energy, materials, mining. I think energy is actually very dangerous right now because I think the whole idea of drill, drill, drill means we're going to have lower prices in both natural gas, maybe not so much natural gas, but certainly oil. So I think that the easy money has already been made there.
So I have a question about energy.
Okay, go ahead.
So one of the things about, we are on paper, energy sufficient and we export energy. But the reason but we also are a very large energy importer. And the reason is because our refineries are set up for Middle East oil and not for US oil. So we have to export all the oil we produce and we have to import the oil we can refine. And with a tariff war going on, will we be able to continue exporting our own oil if other countries, just go buy oil directly from, let's say, the Middle East or from Norway? And so I think the energy risk has gone up substantially just because tariffs are unknown how it's going to play out. Any thoughts on that? And the other question is emerging markets. Again, with a strengthening dollar, emerging market currencies are going to get crushed. And so investing unhedged in emerging markets is risky. This has been the case with India. I mean, when I came to the US, the rupee was 7 to the dollar. Now it's 85. So, and it continues depreciating 5 to 10% every year. So currency risk is significant. Are these returns in emerging markets that people are thinking about after currency hedging?
So I think that there are a lot of questions with regard to energy, and though it generates a lot of cash flow, I think that it's risky. I think energy should have been bought during the 2020 market crash. It's now fairly valued, and there are a lot of questions. So I don't think it's really an attractive investment. And I think that there are a lot of risks, and you just pointed it out. I also think that as it relates to the dollar, I think that the dollar will weaken. I think that that will have a softer Fed. And I think that also as it relates to sectors, I think that you're going to see weakness in the US dollar, and that will help a lot of the emerging markets.
Steve has a question. Yeah. We have a mic somewhere.
Actually, you can just rephrase it.
By the way, please just raise your hand if you have questions.
In relation to producing more energy, in other words, drilling, et cetera, if demand stays the same and you increase supply, obviously prices are going to drop. But theoretically, would demand increase if you drill more because there's tremendous demand growing in the world? So the offset would be higher sales to offset lower prices. It all depends where that break-even point is in relation to higher sales versus pricing, so that you can still have, you're still making a high return on your investment. How do you view that? What would be your comment on that in terms of increasing demand being out there? So even though you're paying lower prices, the revenue is higher. The total revenue coming in is higher.
I worry about the price of oil, and I think that the price of oil is likely to come down. And ultimately, I think that this administration would like to see that. And I think that price is going to have an impact on revenues. But, I think you'll get more business out of it. So I'm sorry, I'm being equivocal. But I'm cautious on energy, but I'm not saying that I don't like it. I think it has a role. In fact, if I may, I just want to do two more slides because what I really came up with is a non-correlated portfolio that yields around 7.5% with 25% in gold with no yields. But you have a lot of attractive income that can be found in closed-end funds, in equities, in bonds, and in the international markets. And you can realize quite a bit of income there with buying good value. And I think that historically I've been a big fan of MLPs, but I think right now they're fully priced and they're not a good bet. And so I think that this particular portfolio, actually about 25% of it doesn't generate any yield whatsoever. So there's a lot of yield that can be had. If you note, in terms of some of these closed-end funds, which are smaller, they're less liquid. And I think that that's where the opportunity is. So those people who are forward-looking and looking at the commodities like gold and commodities in general, that's where income can be found. And to that point, there are two particular names that I want to mention. These are just ETFs. One would be the Templeton Emerging Market Income Fund, which yields 10.5%. I think that makes a lot of sense. And there's a Gabelli Global Gold and Natural Resource Fund, and they write calls against their equity positions, and they generate close to a 9% yield, and that would be non-correlated, meaningful yield. So maybe this isn't a billion-dollar portfolio, but this was created for a guy who's has $2 million. And I think that for retired people, that's the way I want to be investing. But maybe it's not an institutional type client, but you're looking at the opportunities in the less liquid, undervalued areas that are now coming into value.
Can I ask a question about your portfolio?
Yeah.
So what happens if you add, say, 10% Bitcoin to that portfolio?
I think that I'm not sure what to think of Bitcoin. I think that really I've grown to like it more, but I don't trust it enough to incorporate it. So that really becomes something that's individual. I haven't back tested it.
It's uncorrelated. It has a high
Look, I
return.
think that it could be a very good idea. But if somebody said, I don't want China. I don't want China growth stocks. I hate China, but I want Bitcoin. No problem. We can put 10% of Bitcoin into that portfolio and still yield 7.5%.
And why don't you trust Bitcoin?
Jamie Dimon is a CEO of JP Morgan, and he says it's not trustworthy. And he's pretty smart. He may be wrong. I mean, I like Michael Saylor, and I've gotten to know who he is and what his commentary is. And I think there's some appeal, and there's some appeal of, having maybe a little bit of it. And, for some accounts, if they're so inclined, having a little bit isn't a bad idea. I've grown more accustomed to it. It has had a big run. I don't like to buy things after big runs. But, there is this argument that if people use Bitcoin as anchors in their on their balance sheets, and the U.S. Treasury decides to accumulate Bitcoin, they already have through seizures, then I think that it gets legitimized and it could go significantly higher. But for the moment, I wouldn't mind seeing it base for a while or pull back for a while. But the fact of the matter is, Trump is a little bit of a Bitcoin bull. So I feel more favorable, but again, it's had a big run. So I don't like to buy things after they've moved. But, that's it. It really comes down to an individual's choice in terms of the portfolios I run.
It's interesting. I ask a lot of people the same question. Why are you skeptical? And people, if you don't mind criticizing, haven't done the deep research. Their reasons rely on other people like Jamie Dimon or Warren Buffett, people who've done the deep dive, deep research, have other more sound, more rational decision based on their own decision making. So I would encourage you to study it and evaluate it and formulate your own opinion as opposed to relying on Jamie Dimon.
Hey, guys,
Why don't you move over?
so I'm getting a tap to wind up. I'll summarize all three. In fact, I guess all five of us that we've had so far are really focused on the concept of actively managing through sector rotation.
We're not wrapping up. These two have to speak also. Just wrapping up Tyson.
We're wrapping Tyson. So how much time do we have? How much?
We're gonna run late, but catch up.
Oh, all right, cool.
So what I wanted to just migrate over to Mitch Don and say, what are the sources for that reasonable study? I mean, I think Tom Lee, who used to be one of the head economists or one of the head portfolio managers at JP Morgan, publishes a bunch of data on crypto. Any other sources?
There are many
What are your
sources.
top five?
Probably the top one would be Andreessen Horowitz. They have a dedicated $1 billion fund, private equity fund, and venture fund just investing in crypto companies. Obviously, BlackRock's got, I forget how many billion now, 20, 30 billion in their ETF, and they publish a lot of research. And the other companies that have ETFs on Bitcoin publish a lot of research. I particularly like Van Eck's research. They have I don't know, a couple billion in their Bitcoin ETF, but their research department is particularly insightful. I like Fidelity's research on Bitcoin as well. And there, of course, Michael Saylor is, one of the biggest cheerleaders. And if you listen to his talks, he doesn't write as much as he talks, but his talks are fairly persuasive in terms of information sources. But generally, I think everybody should buy Bitcoin, not necessarily to make money, but to learn and study it, because when you put your money down and buy something, you're going to start following the news, and then you're going to make an opinion as to whether or not this is for you or not for you. So I would encourage everybody to put, a tiny amount, if you haven't already, just to follow. So,
Mitchell, I have one more question for you. So I looked at how Bitcoin behaved compared to other, asset classes, and I found a decent beta against the Qs. This is a while ago. I don't know if this is still the case, but have you looked at hedging your crypto and Bitcoin exposure using stock indices? Because it also appears that many people think that the entire Bitcoin rally is a function of overflow of excess cash produced by central banks, and so which are driving up asset prices and equity prices, but also maybe behind creating some of the correlations you get against the more levered stock markets.
right. So we don't use the equity indices. We use other crypto to hedge, so to speak. So there's a stronger correlation between crypto to crypto than there is crypto to equity. So if you wanted to be purely market neutral, and we have 2 of our 4 funds purely market neutral, so they're inherently hedged. So the hedges that we use are, in the case of statistical arbitrage, we have 100 tokens long, 100 tokens short. It's dollar neutral. Both the long and short book are equal. They're beta neutral and market neutral, and that's the way that we hedge, so to speak. But the investment strategy is designed to take advantage of inefficiencies in market pricing. It's not so much making money because crypto's going up or crypto's going down, but it's the fact that there are many. It's a new and highly growing and fragmented industry, so there's a lot of mispricings.
Okay.
And you could take advantage of that by having a statistical arbitrage approach. Of course, the other strategy is just constantly buy low, sell high. When you see Bitcoin prices are different across 10 different exchanges, you just buy in one place, sell in the other place, simultaneously. Now, that used to last for days and weeks. Today, we do that on a millisecond basis, and not just one coin, but 100 coins.
Dale,
I have a follow-up to
Sure.
to your question, Samir, and on Bitcoin and cryptocurrency. So we do track Bitcoin in terms of like performance versus its correlation to say the Nasdaq or the QQQs.
Yeah.
There's been a stronger correlation in the last 2 years, and we actually view it as a leading indicator in terms of where risk and where beta is in the market today. And to Tyson's point
Which leads which?
Bitcoin actually and cryptocurrency and altcoins actually tend to be more speculative, and they tend to actually lead risk assets.
I'll have to look into that trade.
Yeah, I wouldn't necessarily, get in on the opposite trade, if you will, right? If there's a leading indicator of Bitcoin, right?
leading indicators are very valuable.
I'm sure it switches too, depending on the circumstance.
So one thing that we don't really have at all in this conference is much on private equity and venture capital. And you used to buy GP stakes, so can you just discuss that universe as whether it can still generate alpha? Because I'm sure lots of family offices are invested in, especially the venture side of things.
Yeah, it's so GP staking is totally, very much a illiquid investment opportunity. You're buying into minority stakes up to 24.99 or 25% threshold into alternative investment managers. So private equity funds, in the recent years, the more prevalent private credit managers. And typically these investments are made with no exit. So funds that structure in GP staking are evergreen. So they're paid into dividends and distribution dividends as opposed to having a full exit. And the purpose there is to actually hedge against asset risk. So if you're a pension fund manager, if you're a large asset manager, right, instead of writing 100 million LP check into a tech PE portfolio manager, why don't you just invest in the actual GP in a primary transaction and ride along into assets that are retained within the fund for the existing fund life as well as future fund launches. So you actually participate in a steady stream of management fee revenue, and as well as upside for carried interest or performance interest.
Can I comment on?
Sure, of course.
In private equity and venture are more venture, very robust areas for crypto, because there are many companies that are early stage, and they all seek some sort of venture funding. So it's very different than hedge funds that obviously trade in liquid securities. So it's a whole nother area that people should explore.
All right, so I think we need to wrap up, otherwise Marty will kill me. But he's not here, so we'll take one or two more questions.
Can you explain better the hedge strategy? For instance, the hedge strategy in one sense protects risk or sets risk, but how do you make money on the hedge strategy? In other words, it's got to be a spread in order to make money. Otherwise, you don't make money. It's a neutral.
Right. So there, in our two strategies, there's the arbitrage strategy, which is buy in the US, sell in Japan when the prices are different. So it's the investment strategy or trading strategy is inherently hedged, but you buy low and sell high. So that's one thing. In terms of our statistical arbitrage strategy, there's a universe of 20,000 cryptocurrencies. We look at the top 500 that have enough liquidity for us to trade. And then we rank them using machine learning as to what we believe will be their relative performance, rank them from 1 to 500. And the top 100, which we believe are outperforming, go into the long book, and the bottom 100 go into the short book. So the spread comes in our ability to predict which ones will outperform and which ones will underperform. So they're dollar neutral and 100% market neutral and hedged, but the money, the alpha, is based on the fact that the performance models can make a relative ranking of future performance.
Are you using AI in that respect?
It's mostly machine learning, but of course it's
But
It's a
AI.
subset.
Isn't that AI in the
yeah,
sense?
yeah, the answer is yes. But historically, before AI became famous, it was machine learning. And before machine learning, it was people doing it by hand and by eye. Yeah.
Thanks, guys. My question's a little bit on a different angle than most, Samir. You talked about Markowitz model, covariance matrices, and all that's based on, I'm assuming, historical data.
Yes.
So how do you, given the current market environment, given the political environment, especially, to me, the risk is more regime change, that the rules that applied in the past aren't going to apply in the future, or even just a tail risk of a crash.
So there's two things that I do to. So if you just apply straight up Markowitz, the real requirement is for the covariance matrix to be stable. If it's not stable over time, so you generate a covariance matrix every period, monthly in my case, right? It has to be stable, and then it becomes predictable. So you have to do tricks to make the covariance matrix stable. You throw out outliers. You look at clustering. There's all kinds of tools you do. You take before you convert the raw data into a covariance matrix. So that's one thing. But ultimately, rebalancing is what bails you out from regime changes and lets you take a loss when a regime change happens, but you can reinvest into the thing that's appropriate for that regime change right away. The key is to have the algorithm, not just so I've created what I call an ECIO. So I take the market standard deviation and I don't apply that straight onto to build a portfolio directly. I have this intermediate step, which is for that market volatility, what is the correct volatility that your portfolio should have? So I convert the market vol into a suitable vol, which is then fed into the optimizer. And so a simple way to think about this, as an example, is when vol is low, what can you do, right? If things are stable, price change doesn't happen, you can take on leverage, right? You can take on more credit risk. So basically, in low vol environments, you can take high risk.
Manage volatility.
And so manage volatility. In a high risk environment, you can take low risk, and therefore regime changes get adapted for right away through rebalancing. So,
So I actually have a question for Mitch. So Mitch, maybe can you give some conjecture on why you think Bitcoin has gotten to the point where it's gotten over the years? I mean, you've been in this for a long time, right? I mean, I have my own perspective. You know, I think that people undervalued the impact on foreign currencies and foreign exchange. I think that it was said already that the Indian currency has been devaluing for years and years, right? And people who live in those countries don't want to have currency that's devaluing so greatly. But I mean, I think there's other aspects as well. Like I think there's a China trade and other things like that. So, do you want to expound on that a little bit?
Okay. So let me understand. You're saying why has Bitcoin gone up
At
1,000x,
1,000x in 10
or
years.
10,000x or 100,000x in 10 years?
1,000x, yeah.
Yeah. Well, it's actually more. It depends on the exact time. If you bought it at a penny, it's up.
Oh, sure. That's
Right,
from longer
right,
than
or
10 years,
10,
but yes.
Why has it gone up? Well, I think that people just have this fascination with it, and that it's a speculative asset. So the biggest use case is speculation, right? People just find a fascination with speculating on it. And people, get fascinated with the technology. And of course, the underlying technology is disruptive and has many, 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 use cases in every industry. And the flagship, which is Bitcoin versus the other cryptocurrencies, is the cheerleader for the blockchain technology. But it always comes down to more buyers than sellers, right?
Yeah, absolutely. I mean, I think there's a resilience in it that people don't account for, and that people like it who are not in the United States. I'm going to say that 40% of all Bitcoin is owned out in the Eastern Asia, probably.
Yeah, no, but Bitcoin when we got into it 10, 11 years ago, it was very China centric.
Right.
And then gradually China just kicked everybody out. But the three biggest exchanges when we got into it, Mt. Gox had failed. The three biggest exchanges in the world were all Chinese exchanges. And the Chinese were the biggest speculators.
Right. But even then, there's a lot of China investment in Tether today, which then Tether translates into Bitcoin. I mean, if you use AI and you go directly to the source Chinese material, you'll see a lot of discussion of that. It's interesting.
Tether grew up initially because China banned people using banks to buy Bitcoin. So Tether came along
Yes.
as the surrogate
Substitute
for the US dollar.
Yeah, exactly right. I have a question for Dale. Dale, can you talk a little bit about sports investing as an alpha strategy? I think that you have some things that are going on with Formula One and things like that.
Yeah, so I think part of GP minorities taking a subset of that investment strategy that's moved on from alternative investment managers is looking at sports franchises. So the likes of Dial Sports, Arctos Partners have expanded into Big Four League. So your NBA, NHL, MLB, and MLS teams. So they've taken permanent minority stakes, just as you would in an asset manager, to fee in on predictable cash flows, predictable revenues through various streams, as well as assets that the sports teams actually own. So this is a very correlated alpha-driven strategy that folks should take a look at if they haven't really heard of it. Another subset is no one is really looking at bigger sports leagues such as the Formula One, for example, that is more and more prevalent in the US. So that is something of interest that I'm exploring myself.
It's really interesting because we have sports franchises coming to us all the time. I think somebody pitched a Las Vegas-based rugby league, right? So we're seeing rugby, we're seeing lacrosse, women's lacrosse, and there's a lot of advantageous perspectives on that from a real estate point of view, because probably half the franchises out there are in opportunity zones. So there's like a triple tax advantage to doing that. So I don't know if you have any perspective on that also, but.
Yeah, so we've looked at some of the real estate projects surrounding Formula One projects. If you look at Miami, if you look at Las Vegas, those were excellent home runs for the real estate guys that did the hospitality surrounding these projects. Now, I don't think that there are tremendously new Formula One tracks being built around the world in which you could participate in this, but that doesn't take away the potential value there is in these teams still.
Yeah, I'm going to say that, and I'm not sure where the Dallas Cowboys practice facility is, but I think it's in, I'm going to say Plano or Frisco, one or the other. But it's seen as being one of the most spectacular successes in the opportunity zone. And then I think also where the new LA Clippers stadium is going to be is either in an opportunity zone or near an opportunity zone. So I think there's a lot of people who look at that because typically municipalities are very favorable with their terms of real estate. If somebody comes along and says, we're going to build a sports center, and then you get to build all of the real estate around that. So it's really interesting times. So at some point, I'd like to have you back and talk some more about that, or maybe we talked about you're coming on our podcast and talking about that as well. So great. Any other comments on that, or
Can I make a quick question
Mitchell?
on location? I recently moved to Puerto Rico, and I find that the biggest personal opportunity.
Yeah, I'm very favorable towards Puerto Rico, especially when you can provide your own solar power and things like that. So,
Well, this is the tax arbitrage.
yeah, tax.
Guys.
I found that tax arbitrages, having been in this business for a long time, don't last very long. Although this one seems to have some running room on it. So, congratulations on that one.
So
Any other comments from the audience? Any questions? Nobody here wants to buy a sports franchise? Great.
So I know a family office that made its money in multifamily, and they're looking to start buying or create women's cricket franchises. So this as being a untapped area of sports.
Buying Bitcoin at 250 a coin.
So,
Fantastic. Great.
all right.
Well, great job, guys. Thanks so much.
All right. Also, if anyone has questions, we'll be around. So,
Yeah, everybody's gonna be around and most people won't be, many people will be at dinner. So